This video contains meaning of management accounting. It is in Chapter 1, named Introduction, of the textbook, Management Accounting. This chapter briefly explains about the introduction of financial accounting, cost accounting and management accounting. This is more suitable for B.Com, B.B.A, M.Com and M.B.A of all universities of India and foreign countries. It is suggested to study through laptop. Presented by Dr.M.Wilson. Management accounting. Management accounting is concerned with the accounting to management. Financial accounting and cost accounting are not able to provide the relevant information to management for managerial planning and decision making. Financial accounting is providing the historical data in account form as profit and loss account and balance sheet. Cost accounting analyzes the different elements related to the cost of production. But this information are not sufficient for managerial planning and control. Hence, a new accounting system, called management accounting, emerged as an accounting system purely for providing the accounting information for planning, decision-making and control of cost. The term management accounting was first used by a team of accountants who attended the Anglo-American Council on Productivity during 1950. Hence, the subject is of recent origin when compared to the other accounting system. Meaning and definitions of management accounting. Management accounting generally means accounting for management. The meaning of management accounting is well known through the analysis of few important definitions given by organizations and accountants. The important definitions are stated as follows. 1. According to Anglo-American Council on Productivity, management accounting is the presentation of accounting information in such a way as to assist management in the creation of policy and the day-to-day operation of an undertaking. 2. The Chartered Institute of Management Accountants, London, defined management accounting as the application of professional knowledge and skill in the preparation of accounting information in such a way as to assist management in the formation of policies and in the planning and control of the operations of the undertaking. 3. American Accounting Association defines management accounting is the application of appropriate techniques and concepts in processing historical and projected economic data of an entity to assist management in establishing plans for reasonable economic objectives in the making of rational decision with a view towards achieving these objectives. 4. Institute of Chartered Accountants of England and Wales defines any form of accounting which enables a business to be conducted more efficiently can be regarded as management accounting. 5. The Institute of Cost and Works Accountants of India defines management accounting as a system of collection and presentation of relevant economic information relating to an enterprise for planning, controlling and decision making. 6. BBA defines management accounting is the term used to describe the accounting methods, systems and techniques which, coupled with special knowledge and ability, assist management in its task of maximizing profit or minimizing losses. 7. Brown and Howard defines, the essential aim of management accounting should be to assist management in decision-making and control. It is clear from the above definitions that management accounting is a system of accounting which provides information to management for efficient functioning in management through effective planning, control and decision-making. Functions of management accounting. 1. Provision of data. The important function of management accounting is the provision of relevant data to the management for decision-making purpose. It helps the management for proper planning and control of the cost. 2. Modification of data. The management accounting is concerned with the modification of the financial data provided by the financial accounting in a form suitable for management for decision making. It modifies the data like working capital, capital employed, debt and equity, etc. 3. Analysis and interpretation of data. The function of management accounting is to analyze the data in relation to the previous periods. It helps to find out whether there is growth in the operating and financial activities of a concern. In addition to this, the analyzed data are properly interpreted for easy identification for the management. 4. Communicating function. Management accounting performs the function of communication at various levels of management. The interpreted data are provided to top-level management. On the basis of the data, decisions may be taken by the management which are communicated to various employees in the lower level of management. 5. Fix standards at all level. Management accounting helps to fix standard of cost for various activities as an organization. The standard related to material, labor and overheads are fixed on the basis of the past data and experiences. 6. Function of control. Management accounting helps to identify whether the actual performances are deviated from the standard performance. If there is any deviation on the negative side, it suggests some control measures to achieve efficiency at all levels. 7. Provides qualitative information. It provides qualitative information to the management related to the performance, training and motivational factors adopted or to be adopted in an organization. Scope of management accounting. The scope of management accounting is not only in the provision of accounting information to the management for planning and control of cost. It has many more scopes, and the details of it are stated as follows. 1. Financial accounting. Management accounting is based in the data of financial accounting. It analyses the profit and loss account and balance sheet at various periods and give more meaning for the information in the financial accounting. 2. Cost accounting. Cost accounting is concerned with the ascertainment of cost at various level of activities. Hence, the cost data are more required for the management accounting for further analysis so that relevant information can be provided to management. 3. Statistical methods. In management accounting, the statistical techniques like tabulations, diagrams and graphs are mostly applied for analyzing the financial data. 4. Revaluation accounting. Revaluation accounting is concerned with the effective representation of capital in fixed assets. The fixed assets should be revalued to represent the real worth in order to ascertain the correct measurement of the return on capital employed. Management accounting informations are useful in revaluation accounting. 5. Budgeting control. Management accounting helps to prepare the budget for various activities in an organization. It also suggests various methods for controlling deviations in the actual values with the budgetary values for different activities. 6. Inventory control. Inventory is a most important factor for a concern. High inventory or low inventory are not good for a concern. High inventory means blocking of more capital in inventory, and low inventory means interruption in production. The optimum inventory which is most required is determined through the management accounting techniques. 7. Interim reporting. The net result of the activities of a business is known only at the end of a financial year through final accounting. But management accounting provides interim reports to the owners and management often so that they can know the progress of their business. 8. Internal audit. Internal audit is an audit conducted within an organization. For internal audit, relevant records are required which are provided by the management accounting, so that the internal audit can be performed in an effective manner. 9. Taxation. Taxation is done through proper adjustment of depreciation, through proper valuation of fixed assets, correct valuation of inventory, etc. Correct valuation of fixed assets and inventory are done through the management accounting principles. 10. Financial management. Financial management is concerned with the management of the finance in a company. It deals with the effective utilization of the finance so that the fair rate of return on investment is achieved. It became a separate discipline to provide various tools for proper management of finance. The tools in financial management are developed through the data from the management accounting also. Utility of management accounting. The important utilities of management accounting are stated as follows. 1. Planning. Planning is an important factor for efficient functioning of a management. Management accounting helps for planning the cost at different levels, quantity to be produced, sales to be executed, inventory to be maintained, etc. 2. Organizing. Management accounting properly defines the authority and responsibility for different people in the organization. Hence, each one knows their responsibility in the organization. It helps for determining the standard performance in the organization. 3. Coordinating. It helps for coordinating all the activities in an organization in order to attain the common objectives of the business. Linking of authority and responsibility of all individuals helps for coordination of various activities. 4. Motivating. The important tool of standard costing in management accounting is to make the employees more responsible. The employees are motivated to perform more than the standard fixed for them. 5. Communicating. It helps for effective communication at all levels of management. The information provided to top-level management for decision-making is one way of communication, and the assignment of work and responsibilities by the top level on the basis of the management accounting information is another way of communication. 6. Controlling. Management accounting helps for taking effective control at all levels of management and for all activities. The cost of production can be reduced through the cost control measures taken at various stages of production. Tools and techniques of management accounting. Management accounting functions with different tools and techniques in order to provide correct information to management. The important tools and techniques of management accounting are stated as follows. 1. Financial statement analysis. Financial statement analysis is concerned with the analysis of profit and loss account and balance sheet of different periods. It helps to ascertain the rate of growth of a concern. This analysis is done through comparative financial statements, common size statements, and ratio analysis. 2. Fund flow analysis. Fund flow analysis is an analysis to find out the movement of fund from one period to another. It helps to find out whether the fund is properly utilized or not in a year when compared to the previous year. It studies the fund from operation and the movement of working capital. 3. Cash flow analysis. It is an analysis about the movement of cash from one period to another. It helps to find out the reason for the change of cash balance between two periods. It studies the cash from operation and the movement of cash in a period. Installation of management accounting system. The different stages of installation of management accounting system are stated as follows. 1. Preparation of organizational manual. The first step in the installation process is the preparation of organizational manual. Organizational manual is concerned with the division of work for effective execution of the functions of management accounting. It defines the authority and responsibility of all the individuals also. 2. Appointment and training of employees. The next step is the appointment of suitable candidates for the different work defined for the organization. The candidates shall be given suitable off-the-job and on-the-job training so that they can prepare themselves as per the requirement. 3. Preparation of forms and returns. The form and returns required for the execution of the management accounting system should be prepared. The form and returns are not same for all the concerns. Hence, according to the requirement and nature of work, the form and returns should be prepared. 4. Classification and codification of accounts. The financial accounts are subject for analysis in management accounting. Hence, it should be well classified as per the nature of the account and the requirements. Since there are many accounts, there is a need for the classification and after that codification also. Codification is the process of assigning serial numbers or symbols for accounts. It helps for easy identification of accounts. 5. Formulating a suitable system for integration of cost and financial data. Since management accounting uses the data from financial accounting and cost accounting, there should be a suitable system for integration of the data from these accounts. It avoids duplication of data. The integration system should be accurate and reliable. 6. Setting up of suitable budgetary control system. Budgeting is an important tool in the management accounting. Hence, a suitable budgetary control system should be established. The system should be a flexible one to accumulate the changes in future. 7. Formulating suitable techniques for standard costing. The fixation of standard for all activities related to cost and revenue is a must to measure the deviations of actual performance from the standard performance. Hence, a suitable technique should be devised for standard costing to fix standard at all levels. The standard should be one which can be adopted by a normal employee. 8. Formulating suitable operational research techniques. Operational research techniques are providing various tools for managerial decision making. The suitable tools for the purpose of management accounting should be identified on the basis of the nature of the business and managerial information requirement. Limitations of management accounting. Management accounting is providing information to management. In spite of its many advantages, it has few limitations, and the important limitations are stated as follows. 1. Management accounting is based on financial accounting. All the analysis carried in the management accounting is based in the financial accounting information, i.e., profit and loss account and balance sheet. Any manipulation and error committed in these statements will affect the results of the analysis of the management accounting. 2. It is considered only as a tool. Management accounting is only a tool and it will not prepare any statutory documents except cash flow statement. Cash flow statement is required only for the listed companies. It provides many techniques only for managerial decision making. 3. It can be adopted only by big concerns. The adoption of management accounting needs more expenditure towards maintaining additional staff for this purpose. Hence, it is possible only for big concerns, and small concerns are not able to adopt this system. 4. Personal judgments. Management accounting information are mostly based on personal judgments about projection of costs and revenues about future. If the management accountant is not efficient, the judgment may not be correct and accurate. 5. Personal bias. There is possibility of showing personal bias in management accounting. This is possible in the area of allotment of work and responsibility accounting. 6. Evolutionary stage. Management accounting was recently originated. The companies are adopting the system only from 1950 onwards. Hence, it has not developed much to meet the complete requirements of the management. 7. Opposition to change. There is possibility of opposition from the employees of the company for the introduction of management accounting system. This is because management accounting may expose the performance of inefficient workers. Management accounting and financial accounting. The following are the differences between management accounting and financial accounting. 1. Management accounting is concerned with the preparation of various statements meant for managerial planning, control, and decision making. Hence, it is future oriented. But financial accounting is concerned with the recording of past events only. 2. Management accounting aims at providing information for the management. Financial accounting aims at providing information external to the management, like shareholders, debenture holders, creditors, government, etc. 3. There is no time limit in the preparation of accounts and statements in management accounting. It may be prepared for 15 days or 1 month, 2 months, 3 months, etc., as per the requirements of the management. But, financial accounting is prepared only for 1 year. The profit and loss account and the balance sheet are prepared at the end of the financial year. 4. Management accounting is concerned with quantitative and qualitative information. But financial accounting is concerned only with quantitative information. 5. There is no compulsion for the preparation of management accounting. Financial accounting is compulsory according to the Companies Act 1956. 6. Reports of the management accounting are not circulated to external parties. It is only provided for the management to take managerial decisions. But the reports of the financial accounting, including the profit and loss account and balance sheet, are circulated to the external parties also. Management accounting and cost accounting. The important differences between cost accounting and management accounting are as follows. 1. The purpose of management accounting is to provide information to the management for decision making. The purpose of cost accounting is ascertainment of cost at each stage of production. 2. Management accounting purely aims at the future on the basis of past information. Cost accounting is prepared mainly on the basis of past and less emphasis is given for the future. 3. Management accounting is prepared without adopting any specific and rigid rules. It may be prepared according to the will of the managerial personnel. But cost accounting is prepared on the basis of some rules and regulations prescribed by the ICWAI. 4. The reports of the management accounting are not subject to statutory audit. But the report of the cost accounting is subject to statutory audit. 5. The reports of the management accounting are useful only for the internal parties. But the reports of the cost accounting are useful both to the internal and external parties. Management accountant. The person responsible for providing information to management is called management accountant. There are different names for different companies for management accountant, like chief accountant, financial advisor, financial controller, etc. Management accountant is responsible for the preparation of management accounting. He works with few subordinates. He has to assign work to them for effective preparation of accounts related to management. His work is not only to look after the activities of his subordinates, but also all the employees of the organization. On the basis of the information provided by him, the management fixes the standard and responsibility of all the employees of the organization. The information provided by management accountant is also based on the efficiency and performance of the employees and the infrastructure available for the company. Hence, he is more connected with the employees of a company. His main work is preparation of budgets, standard costing, marginal costing, and financial statement analysis. On the basis of financial statement analysis, he has to prepare the fund flow statement and cash flow statement. These statements help to ascertainment whether the fund of the company is effectively utilized or not. Moreover, accounting ratios are also calculated based in the financial statements. This information helps to fixing good standards and effective responsibilities. Hence, the management accountant plays an important role in an organization as the planning, coordinating, directing, and controlling of all the activities, through the various information he is providing to the management. Functions of management accountant. 1. Planning. Planning is an important function of management accountant. Planning is done through budgeting and standard costing. Proper planning based on management accounting helps in the efficient functioning of an organization. 2. Coordinating. The objectives of a concern can be achieved through proper coordination. It is the duty of the management accountant to coordinate all the activities of an organization. 3. Motivating. The employees of an organization are properly motivated by fixing the standard of performance. The curiosity to perform more than the standard automatically motivated the employees to produce more goods. Management accountants should take necessary steps in this respect. 4. Directing. Management accountant takes steps to direct the employees to do different works efficiently through standard costing, marginal costing, and budgetary control techniques. Each employee is directed to accomplish his responsibilities. 5. Controlling. Controlling is concerned with the control of cost for various activities. If the actual cost is greater than the standard cost, it requires some controlling mechanism. Management accountant takes various steps for controlling costs at different stages. Controller and treasurer. Controller and treasurer are the terms associated with management accounting. They are in charge of all the financial transactions. They provide crucial information to management. Due to the role played by these personnels, controller or controller is a term used in USA for the top management accountant executive in a firm. Hence, these terms are more associated with USA. Controller is more concerned with the establishment, delegation, and execution of the activities of an organization. His duty is also to report to the management about the result of the activities in order to help the management for planning, controlling, and decision making. His duties are defined by Controllers Institute of America. These duties are the duties which are to be executed as a management accountant. The treasurer is responsible for the management of the funds of a concern. He has to ascertain the financial needs of a company, the ways in which the needs are to be met, utilization of the funds, and ascertainment of the fair return on the investment. He has to see that the funds are effectively utilized to give a fair return. The role and status of controller and treasurer can be known through the organizational chart stated as follows. The role and status of controller and treasurer can be known through the organizational chart stated as follows. Exercises are presented here. Exercises are presented here.